The richest country in the world has a problem that not even money can fix. $36 trillion in national debt, more than the GDP of China, Japan, India, the UK, and Germany combined. This isn't just economics, it's a geopolitical time bomb. The IMF is ringing the alarm. Credit rating agencies are pulling the plug. The US isn't preparing for a rainy day, it's borrowing umbrellas from everyone else, while it's already flooding. Hey everyone, welcome to Money Route, your guide through the financial maze of our rapidly shifting world and your trusted destination for decoding economics, wealth, and global power games. If you're ready to understand what they won't teach you in school, strap in. This episode dives into the biggest financial threat in modern history and the truth behind America's debt bomb. America's $36 trillion debt isn't just a number. It's the most dangerous domino in the global economy. And when it falls, everything could come crashing down. The U.S. national debt now exceeds 122% of its GDP. It is worse than during World War II, worse than 2008, and growing at over $1 trillion per year. The debt is so large that if America paid $1 per second, it would take over 1 million years to repay. Why it matters globally: global GDP, approximately $105 trillion US share, approximately $25 trillion US debt, 36+ trillion dollars. It would take all global income just to pay this debt off in a year. Debt surpasses China, plus India, plus Japan, plus UK, plus Germany. GDPs combined. Truth 1: America has a Gen Z spending problem. The U.S. behaves like a teenager with a $3,000 income but wants $20,000 sneakers. Defense spending, $800 billion, is higher than the next 10 countries combined. Yet defeats like Afghanistan persist. Mandatory programs like Social Security, Medicare, and defense equals 70% of federal budget. U.S. borrows in good times and bad. No discipline. Truth 2: the tax scam of the century. Reaganomics and trickle-down theory promised more jobs via lower taxes for the rich. But bottom 20% got 3% of tax cuts. Richest 20% got 65%. Income inequality soared. Result: rich got richer. The poor got crumbs. Truth 3: interest is a silent killer. U.S. spends nearly $1 trillion per year on interest alone. That's more than the GDP of 174 countries. Debt compounding plus interest equals exponential trap. Truth 4: the debt ceiling is a joke, raised or suspended over 70 times since 1960. Debt ceiling equals symbolic political tool, not an actual limit. China. From $1.3 trillion in U.S. bonds, $759 billion. Japan. From $1.84 trillion, $1.06 trillion. Reason? Falling trust, rising risk. Yields rising equals bonds are cheaper because fewer people want them. Even allies like the UAE and Saudi Arabia are diversifying away. Trump's 2017 tax cuts were temporary. New bill makes them permanent and adds increased defense spending, cuts to healthcare. Little benefit to middle and lower class adds 3.3 to 5.2 trillion more debt, equal to India's or Germany's GDP. We are in the late stage of the long-term debt cycle. What comes next is either transformation or collapse. Ray Dalio, founder, Bridgewater Associates. Ray Dalio isn't just another financial commentator. He runs one of the world's largest hedge funds, and his predictions carry global weight. He's been warning for nearly 2 decades that the U.S. economy is on a trajectory toward a catastrophic correction, a full-blown economic heart attack. Why is Ray Dalio so alarmed? The long-term debt cycle is ending. Every empire historically follows the same path: debt buildup, currency debasement, internal conflict, collapse. This happened to the Dutch Empire, the British Empire, and now the U.S. is next on the list. Symptoms of the heart attack: spiraling debt to GDP ratios, high interest burdens $1 trillion per year just for interest, political gridlock, unable to pass real fiscal reforms, declining trust in U.S. institutions and currency, social unrest, and rising inequality feeding instability. Dalio's fear: the no room to maneuver trap. Normally, a country can lower interest rates or print money to ease crises. But today, interest rates are already elevated, and inflation is volatile. If the U.S. prints more, it risks hyperinflation. If it doesn't, it risks recession. This is the definition of a trap, and Dalio's diagnosis is clear. America needs a radical fiscal reset, or prepare for impact. You might think America's problems are its own, but the world is financially intertwined. If the U.S. collapses under its own debt, it sets off a chain reaction. Global capital flight. Global investors see U.S. bonds as a safe haven. But when the U.S. itself becomes risky, capital floods out of developing economies back into dollar-denominated assets. India, Brazil, Nigeria, South Africa, these markets will see massive foreign portfolio exits. Stock markets crash, currencies weaken, inflation soars. What happened in 2008 and 2011? In 2008, Lehman collapsed, and India's Sensex fell by over 50% in 12 months. In 2011, a U.S. credit downgrade led to 10% erosion in India's market value in weeks. This isn't just history, it's a repeating pattern. What's at risk for India? India holds $237+ billion in U.S. Treasury bonds. If bond values collapse or inflation rises in the U.S., India's forex reserves lose real value. Foreign institutional investors, FIIs, leave, tech stocks collapse, the rupee weakens, and imports become expensive, creating stagflation. What about the rest of the world? Oil-producing nations like Saudi Arabia and Qatar may struggle if global trade slows. Export-driven economies like Germany, South Korea, and Vietnam will be hit as U.S. demand contracts. African and Latin American countries heavily dependent on dollar-denominated loans could default on sovereign debt. This is not an American debt crisis. It's a global systemic risk. Quantitative easing, QE, has been the Fed's go-to magic wand since 2008. It means printing money out of thin air to buy financial assets, mostly government bonds, to stimulate the economy. QE in the past. Between 2008 and 2014, the Fed printed $4.5 trillion. During COVID, another $5 trillion was unleashed. This flooded the markets with liquidity, artificially boosted stock prices, and kept interest rates near zero. But here's the catch: in 2025, QE is addictive. The U.S. economy is now dependent on cheap money. Like a drug, QE brings quick relief but long-term damage. Inflation limbo. In 2021 to 2023, we saw inflation surge to 40-year highs, 7 to 9%. If QE resumes now, hyperinflation becomes a real possibility. Loss of confidence. If global investors see America printing endlessly, they lose faith in the dollar. We risk a currency crisis, not just debt. A dangerous option. While QE can buy time, it no longer solves structural issues. It's like putting a Band-Aid on a bullet wound. And if the Fed prints its way out of the current crisis, it may accelerate the path toward monetary collapse. Can the U.S. realistically defuse this debt bomb? Yes, but the path is narrow and politically treacherous. Fix 1. Tax reform. Reinstating a wealth tax or higher capital gains taxes on ultra-wealthy Americans, closing corporate tax loopholes that cost the U.S. over $1 trillion per year, making estate taxes progressive again. Fix 2. Military spending cuts. Cutting just 10% of defense, $80 billion per year, could cover vast social programs. Focus on domestic infrastructure rather than global policing. Fix 3. Raise retirement age. Gradually, Social Security and Medicare are the largest liabilities. Raising the retirement age from 66 to 68 or 70 could stabilize payouts. Fix 4. Debt restructuring. Similar to what Greece and Argentina have done. Renegotiate long-term debt at lower interest rates, convert some short-term debt into GDP-linked bonds. Fix 5. Create a national wealth fund. Like Norway's sovereign wealth fund, use energy revenue and innovation to build a future buffer. But here's the truth. These reforms require political consensus, long-term thinking, and short-term sacrifice. In an era of polarization, America's greatest threat isn't financial, it's political paralysis. The U.S. dollar is the world's reserve currency, but that privilege is now under threat. The dollar's standard 60% plus of global reserves are held in dollars. 80% of world trade is invoiced in dollars. Nations buy U.S. bonds to store value safely. Why that could collapse? Excessive debt equals declining confidence. Weaponization of the dollar, sanctions against countries like Russia, pushed BRICS to seek alternatives. Rise of CBDCs, China's digital yuan is gaining traction. Gold is resurging. Central banks are stocking up faster than at any time since the 1960s. Petrodollar is weakening. Saudi Arabia is now accepting yuan for oil trades. What happens if the dollar falls? Every country holding dollar reserves loses billions in value. U.S. imports become dramatically expensive. Fueling domestic inflation, U.S. loses ability to print its way out of crises. Wall Street crashes, commodities skyrocket, and the global financial system faces massive realignment. Final warning, if the dollar collapses, the US won't just lose its economy, it will lose its empire. The American dream might have been sold on credit, but reality always collects. If nothing changes, the debt bomb will explode, and the world economy will never be the same again. If you found this breakdown eye-opening, don't just sit on it. Share this video, help others see what's coming, and stay educated. Subscribe to Money Route for more deep, fact-driven breakdowns of the stories the world can't afford to ignore. Hit that bell icon, because in a world this volatile, timing is everything.